Finance Professor at MTSU. In this video, we'll go through Chapter 7, Risk-Free Rate and Active Risk Premium. As you know, the fundamental theory of finance is based on CAPM model, capital asset pricing model, and this model reveals a very basic relationship between risk and return. Expected rate of return of any stocks or any financial assets equal to risk-free rate plus beta times active risk premium. And in this chapter, we are going to address details of this risk-free rate and active risk premium. So what is risk-free rate? And risk-free rate is a theoretical concept, and there are three conditions for risk-free rate. First of all, risk-free rate indicates the rate of return on assets that has no default risk. And the second, this asset also carries no reinvestment risk. And the last one's pretty important. This risk-free rate has something to do with the duration matching principle. Essentially, if you are going to estimate a long-term asset valuation by using this risk-free rate, then this risk-free rate should be based on the long-term duration, not a short-term duration. So three conditions: no default risk, no reinvestment risk, and there's a duration matching principle. And for long-term assets, we are looking for long-term risk-free rate. Now, what's the risk-free rate today? Well, you may have many guesses, or some people say, hey, right now the risk-free rate should equal to 5%, which is a long-term US 30-year bond rate. Is that the only number that we can use? The answer is no. The answer is no. We have multiple numbers that we can utilize to find approximation of risk-free rate. As I said, this is approximation, not the most concise or accurate number. Why is that? Because risk-free rate is just a theoretical concept, and in the real world, you just cannot find a pure risk-free rate. However, we can find a proxy for risk-free rate. This proxy of risk-free rate should be very close to the real risk-free rate. Now, what are proxy for risk-free rate? Well, previously you might ask a similar question: what is the proxy for risk-free rate? Well, as amateur, you can ask the question of what is the risk-free rate, but as a professional, you can ask a more sophisticated question: what are proxies of risk-free rates? And here I want you to know that the essence of this class is all about detail addressing. Well, as amateur, you may know the theory, you may know the formula, and you may know the major methods of getting security pricing valuation, but from professionals' perspective, we are going to show, or we are going to have multiple tools to solve the same problem. And in this case, our goal is to find a proxy for risk-free rate. And from professionals' perspective, I can show you that we will have multiple proxies for risk-free rate based on different perspectives. Well, here here's a candidates for good proxy for risk-free rate: U.S. government securities, T-bills, T-notes, and T-bond. Why is that? Because we assume that U.S. government securities carries no default risk, right? So U.S. Treasury securities are good proxy for risk-free rates. However, when we look at a second principle, risk-free rate should carry no reinvestment risk. Well, in this case, any coupon bonds like T-bonds or T-notes carries reinvestment risk. It's better to find a short-term rates as proxy for risk-free rate, because shorter-term bonds carries less reinvestment risk, and also coupon matters. Bigger the coupon, the bigger the reinvestment risk. It's better to have zero coupon bonds as a proxy for risk-free rate. And the last one is duration matching. Well, we have 30-day T-bills, 10-year T-notes, 30-year T-bond. Which one would be a better proxy for risk-free rate? Well, when you look at the duration matching principle, you would say, hey, we need a long-term rate, like a T-bonds, because equity valuation involves long-term cash flows. Therefore, risk-free rate should match its long-term feature. And in this case, T-bond would be the best choice. But T-bond are coupon bonds. It carries reinvestment risks, right? And well, in reality, what is the best proxy for risk-free rates? Before we answer this question, let's take a look at another concept regarding this risk-free rate. Nominal rates versus real risk-free rates. Well, nominal risk-free rate equals real risk-free rate plus inflation rates. The difference between nominal rates and real rates are inflation rates. So the question here is, should we use this pure real risk-free rate or this nominal risk-free rate? Well, some people say, hey, we should use this real risk-free rate. Is that correct? Well, in reality, you need to take a look at the nature of cash flows in a stock or in a bond, because in the future, those cash flows are in nominal terms. Therefore, we should use nominal risk-free rate. So how to find the real risk-free rate? Well, real risk-free rate can be found in TIPS, Treasury Inflation Protective Securities. And this is the only U.S. Treasury securities that fit out the inflation rate risk, because TIPS will adjust its principal payments and interest payments based on the extent of inflation. If the inflation rate is high, they will pay higher interest and higher principals. So essentially speaking, TIPS are securities that is free of inflation rates. Therefore, the TIPS rates reflect so-called real risk-free rate. Now we have three major proxies for risk-free rate. The first one is US 10-year T-note rate, and this is a standard Wall Street professional use risk-free rates. And if you go to Bloomberg and check risk-free rate, people say, hey, the best proxy for risk-free rate is 10-year T-note rate. And right now, in April year 2020, the 10-year T-note rate is in the range of 0.5% to 1%. So in this case, risk-free rate is about 0.5%. If we use 10-year T-note rate as proxy for risk-free rate. But this is not the only way that we can get the best estimate of risk-free rate. Here, I would like to use the word of estimation. Risk-free rate is a theoretical term. In the real world, we can only find a good estimation of risk-free rate. And this 10-year T-note rate is one of those proxies. And other than 10-year T-note rate, we have two other choices. The second one is based on the concept of real risk-free rate. As you know, the TIPS rates proxy for real risk-free rate. And since we need to use the nominal risk-free rate, therefore, another way for us to come up with the estimation of risk-free rate is to find TIPS rates. Let's say US 10-year TIPS rate plus the current inflation rate. And right now, TIPS rate is about 0.2%, and inflation rate is about 2%. And you would come up with 2.2% risk-free rate. And this number is significantly different from 10-year T-note rate. Why is that? Because the current COVID-19 crisis affect the treasury security market very significantly, and a lot of people are floating from equity market to the bond markets, which caused bond market price to increase significantly, during the most recent 3 months, and this rate carries the risk of COVID-19 crisis around the world. But this COVID-19 event is a temporary event, and asset price could be misrepresented on the financial markets. So if you use 10-year T-note rate, you actually have the risk of underestimating this risk-free rate. So we needed to have second opinion, third opinion, and the second opinion is look at this tips rates and inflation rates. And the last one is U.S. long-term real growth rate plus inflation rate. And here we look at the fundamentals of risk-free rate. What is the risk-free rate? Well, risk-free rate is the price of risk-free asset. Right? And fundamentally, this rate is based on economic growth in the longer term. So the third method for us to get approximate risk-free rate is to look at the long-term real growth rate, and then we plus inflation rate. And right now, let's say you assume that the real growth rate would be, let's say, 0.5% or maybe 1% in the US. When I say long term, that is not just the 2 to 5 years. It involves 10 years, 20 years, or even 100 years. That's what long-term growth rate means. And you can look at the past growth rate of U.S. economy during the last 100 years to see what is the real growth rate. And in the future, you would say, hey, future growth rate would be similar to what happened during the last 100 years, right? But you may have different opinion. People say, hey, right now we have really awesome technologies like AI, which will increase productivity tremendously for this global economy. Therefore, long-term real growth rate could be higher than what we saw in the past 100 years. I mean, in this case, you might be right. So, but anyway, this long-term real growth rate is foundation for risk-free rate, and then we add inflation rate to get another measure of risk-free rate. So we have three major ways of getting risk-free rate. So when you talk about this risk-free rate as a professional financial analyst, right now you have three tools to utilize. 10-year T-note rate. That's your first tool, and the second tool is tips rates plus inflation rate, and you also have third tool, long-term growth rates plus inflation rate. So after this chapter, well, I would say, hey, every one of you should build a toolbox. That's toolbox of your future financial analyst career as a professional. And any professionals carries a professional toolbox. And in this toolbox, you have lots of tools that can facilitate your professional work. In this case, it's financial analysis. And previously, hey, long-term, risk-free rate should be equal to 30-year T-bond rate, but actually it is not. In this real world, we have three major tools to fix this risk-free rate. And the long-term T-bond rate is not it could be a decent risk-free rate proxy, but it's not one of the best. And we have three best risk-free rate proxies. Once again, they are 10-year T-note rate, 10-year tips rates plus inflation rate, and the long-term real growth rate plus inflation rate. And from professionals' perspective, we really want to check all three numbers. And sometimes one of those numbers may be mispresented on the financial market. That is okay, but if you can incorporate all three numbers, then what I can say is that your estimation for risk-free rate is pretty good. Then we have a little additional tools that you can utilize regarding this risk-free rate, which is associated with the foreign country risk-free rates. And as financial analysts, sometimes you need to estimate risk-free rate for foreign equities. not only because you needed to invest globally, but because the company that you are going to work, the company that you are working in the future may have opportunity to have overseas investments, overseas operation, and so on and so forth. So let's take a look at how do we estimate risk-free rate in a foreign country. Well, the difference between risk-free rate in the US and the risk-free rate in a foreign country is, first of all, the default risk. Default risk, because foreign country government bonds carries default risk. And here we have two major methods to estimate foreign country risk-free rate. The first one is default risk spread. Default risk spread. And the foreign risk-free rate equals foreign government bond rate minus default risk spread. Default risk spread. And the second method is build-up method. You look at the long-term real growth in a foreign country, then you add expected inflation in that country. Now let's take a look at one example. Let's say the Indian government had a 10-year Ruby bonds outstanding with a yield to maturity of about 7.87% on January 1st, year 2015. And the Indian government had a local currency sovereign rating of BAA3, and the typical default spread for BA3 is 2.2%. And what is risk-free rate? Well, here we just apply the first method. The risk-free rate in India equals Indian government bond rate 7.87% minus the default spread of 2.2%. Therefore, the risk-free rate in India back to January the 1st, year 2015 would be 5.67%. Once again, this number is not a 100% precise number, but it's pretty good estimation of risk-free rate in India. And this table showed you the typical default spread in year 2004. And you see, the higher the rating, foreign government bonds, the lower the default spread. And for BAA3, the default spread is 2.2%. For CAA3, that's 10%. And for AAA, that is 0%. So higher, the worse the credit rating, the higher the default spreads. And this table showed you the CDS spreads in year 2015 in many different countries. CDS spreads in many different countries, and let's say on the left hand side of the table you see here Germany. Germany had AAA government bond rating, and their CDS spread is 0.74%. On the right, let's say you look at Russia. Russia has BA2, and it carries CDS spread of 5.63%. So what is CDS? CDS is a financial derivative. Credit default swap. Credit default swap. That is the most popular derivative trading on the market nowadays. And credit default swap actually can tell investor what is the default spread in certain bond. Other than those two previous methods, we have the last method, which is based on the market approach, and we have two variations in method 3. And the method 3 is based on market observation, and this method believes that the market participants have the best knowledge regarding estimation of risk-free rates and other fundamental financial metrics. We have two variations here. First one is to use the exchange rates that you can observe on the exchange rate markets. And the second one is by looking at inflation rates. Well, the first one tell you that the forward exchange rate equals spot exchange rates times 1 plus foreign country risk-free rate divided by 1 plus the US risk-free rate. And this is the well-known official equation in international finance area, and it shows you the fundamental relationship between forward rates and spot rates for foreign currencies. And here, let's say foreign risk-free rate can be set as unknown if you know forward rates, and both forward rates and spot rates are observable on the markets. And if you have the US risk-free rate estimation, then you can use this equation to figure out foreign risk-free rate. That's the first variation based on financial market information on foreign currency markets. And the second one is based on inflation, and this is another equation that you can utilize, which means the relative risk-free rate between a foreign country and the U.S. Is exactly equal to the relative foreign inflation rates and U.S. inflation rates. Okay, that concludes the discussion of risk-free rate. I hope you enjoyed this short video. At the end of the video, I wanted to emphasize one more time what we are going to do in this class is to address all the details regarding equity valuation. And why do we need to address those details? Well, I mean, any finance majors graduating from their bachelor degree already have all the perspective that you need to do financial analysis, right? You have the theory, you have the equation, but to become a professional financial analyst, those things are not enough. We needed to address all the details regarding every aspect of asset valuation. So, what to make you a professional? Well, a professional can address a lot of details. Amateurs cannot. Professionals have a toolbox, a very powerful toolbox. And in your toolbox, it was empty before you come to the class today. But right now, in your toolbox, you have 7 tools. 7 tools already, right? First of all, you have 3 tools to get the estimation of US risk-free rate. 3 tools. What are they? 10-year T-note rate, TIPS rates plus the inflation rate. And the third one is US long-term growth rate plus inflation. 3 tools. Risk-free rates in the US. And for foreign risk-free rates, you have 4 tools based on 3 methods. Right? And the first one is, let me go back to this foreign country risk-free rate. The first one is based on default risk spread approach. That's your first tool. And the second tool is build-up approach based on long-term growth and inflation rate. And the third one, which has 2 variations. One is based on foreign currency exchange market information, and the second one is based on relevant inflation between US and a foreign country. So at the end of the class, you have 7 tools in your toolbox. I hope you enjoyed this video, and I think you should be able to fix a lot of questions in chapter 7, at least half of those regarding risk-free rate. And I want you to practice those odd number questions. And in your first exam, you will see even number questions appear in your first exam.